Welcome to Retirement Mentorship. My name is Freeman Lindy. I'm a certified financial planner, an enrolled agent, which is a tax advisor, and I help clients all the time, pretty close to retirement, kind of 55 plus, make that transition from working in or before retirement and transitioning into retirement. We'll do everything, right? Taxes, investments, financial planning, all those things. And so that's what I do. And so we make these videos to help people do it better. Right. And there's a lot we can do that we do with clients, a lot of things that I don't have time to tell them in person. So we want to make these things to help educate both my clients, to tell them more things that I can't tell them in person, help them stay the course, but also to educate the public as well about everything that's available out there. So if you want, you can tune in live, 4 p.m. Central on YouTube every week. We're going to broadcast this live, kind of a bigger episode where we'll do a main topic, a Q&A, some other segments. One of those segments is going to be Freeman Rants, which we'll do today. And then if you want to participate, right, come in live. You can join the YouTube chat. You can throw questions in there that we can answer at the end during our Q&A. Or if you have other questions and can't tune in live, you can send those to questions@retirementmentorship.com, and we'll collect those and just kind of address them on the show. If we get too many questions, I might do some random spin-off shorts and stuff on those. So make sure you subscribe to the channel as well as tuning in on Wednesdays. If you can't make it live again, it will post on our channel. So subscribe and you'll get notified when those things become available, and you can stay tuned in to what's going on. So the big topic today, should I do a Roth conversion in 2026? So Roth conversions are a perennial issue in financial planning. Should we do them? They're one of the main levers that we can pull to kind of control our taxes, when we pay taxes, how much we pay. And so it's always a question. And with some of the new law changes that came about last year, in 2025 with the One Big Beautiful Bill Act, and a lot more changes that were made effective, I was just questioning, like, hey, have enough things changed? Should I be doing them now? How do I think through this, right? So that's what we want to cover today. Last week we covered, should I contribute to a Roth in 2026? So go back and watch that if you're still working. But whether you're working or not, Roth conversions may be applicable to you. So we want to cover a bunch of things with that. So first, I'm going to touch on this briefly. I covered it more last video, so you can go back and watch that if you want to. But just some quick Roth IRA, traditional IRA basics. So as we look at the chart here, right, you've got traditional accounts, non-qualified, or just kind of normal brokerage accounts, Roth accounts, and HSA accounts. And so the way that these work, right, is a traditional account will be comes in pre-tax. And then as long as it stays in there, any growth in there is tax deferred. And then when it comes out later on, it is taxed when you pull it out of the account. So as long as it stays in the account, you don't pay any taxes on that account. After tax accounts here then are, you put money in after you've already paid taxes on it. It's taxable inside there. If it gets dividends and interest will be taxable as it's in there. And then when you pull the money out in the end, or if you sell things, you also pay taxes on that. Roth, you put after-tax money in, gross tax deferred, is tax-free with a bunch of asterisks on there. You got to make sure you follow the rules. And then HSA is the only triple tax-free account that we can get for those, right? So that's generally what that is. And so you can make contributions into either one of these, right? While you're working, as long as you have earned income, you can contribute to them. Again, we covered that last week, and that video is live on the channel. And so now we're going to talk about another option that you have, which is we can take money from our traditional and move it straight into a Roth IRA, and that's called a Roth conversion, right? And that means, so you have Roth contributions, which is money from other sources straight into these accounts, and you have Roth conversions, which is going from traditional to Roth accounts. IRAs are the most common place this happens, traditional IRA to Roth IRA. Some 401ks now let you do this. The thrift savings plan, for example, the big government 401k, just started doing that this year, where you can now do an in-plan conversion. And so the tax ramifications are the same no matter where you're doing it. It's just whether or not you can actually mechanically get it done. And so the question is, like, right, should we do this? We know, right, anytime you pull money out of an IRA, you're going to pay taxes. So if you do a Roth conversion, basically what we're doing is we're saying, hey, we want to pay the taxes now whenever we do the conversion, so that from that point forward, it can continue to grow Roth tax deferred and eventually be pulled out tax-free. So you're still only going to pay those taxes once. Now, again, there's a bunch of timing rules on this. 5-year rules, which are apply more if you be underneath 59.5, younger than 59.5, less so if you're over. And so again, there's still a bunch of rules. We're not going to get into all the rules of Roth. Maybe we'll do a deep dive on Roth sometime if you want us to. Put it in the comments or send us an email if you think that'd be interesting. But in the meantime, that's kind of what we're talking about, right? When do we want to pay the taxes? Do we want to pay them later on when we just pull it out for income? Or do we want to do conversions to pay the taxes now and so that it can grow and be used tax-free later on? Now, where do we pay these taxes from? Quick note, right? One, you can pay the taxes, you can just withhold taxes from that conversion, right? So if you send $10,000 in a Roth conversion and you withhold at 20% tax withholding, or 22, say in the 22% tax brackets, you're like, hey, I want to withhold 22%. So you would withhold $2,200 plus state. If you're in a taxable state, you might want to do that too. But at the end, then, right, only $7,800 would actually go into your Roth, right? So that'd be one way to do it. The other way to do it is to just pay the $2,200 out of a different source. Maybe you've got some non-qualified accounts, or you've got a bank with a bunch of extra money, and you're like, hey, I would rather just pay the taxes out of that instead. Well, then the full $10,000 would actually hit your Roth, and so that would be more money in the Roth at the end. You have to have that money elsewhere to do it, but that is usually, I would say, if you're wondering what's best, in general, you're better off paying taxes from another source if you can. Most people don't have another source to pay them, but if you can, pay it out of something else, because then you get the maximum amount into your Roth. Especially since, right, especially later on, if you're not earning any more money and you can't make Roth contributions, if you've already maxed those out there and you got a lot in non-retirement accounts, there's no way to get this in here if you've already maxed out your contribution limits, which we talked about last week. And so if you have a bunch in here, even though you can't directly get it in there, by paying the taxes on your Roth conversion out of these accounts, it's kind of like you're getting more of that money in there, because at the end you end up with less in here and more in here. And so it's kind of like you're able to sneak a little bit more in there. So that's usually what we recommend. If you're underneath 59.5, you definitely don't want to withhold, and you want to pay separately, we'll say. Because if you do withhold, like this 2,200 here, that would be considered a distribution, and you'd be both taxed and penalized on that part of the conversion. So you don't want to withhold if you're under 59.5. You definitely want to pay separately. So that's a little bit about how Roth conversions work. So the question is, should you do them? Is this a good idea or not? And this is where, again, we come back to our tax brackets, which, again, we looked at a little bit last week. Go watch that. But right, you've got your taxable income going up here. You know, the first 32,000 or so as a married filing jointly couple, you pay no taxes on. Then for the next 24,000, you pay 10, then 12, then 22, etc., all the way up on each of these breakpoints there. It's a progressive tax system, right? And so if you go from 12 into the 22% tax bracket, you don't pay 22% on everything, just the amount over this threshold, right? And so the question becomes, when are we paying taxes? Are we paying taxes now versus later? What's the best strategy? Because ultimately we can either pay them now doing a conversion, and then what would we pay later on, right? We can do it now at 2026, but in whenever we're going to pull that money out, what are we going to pay then, right? And so for a lot of people, let's say you're working and you are in the 22% tax bracket and your taxable income is about here, but in retirement sometime in the future, you think you're going to be here. Well, now I don't know if I'd want to do a Roth conversion in that standpoint, right? Because now you are electing to pay 22% now just so you can avoid paying 12% later on. And that wouldn't necessarily make sense, right? On the other hand, if you are solidly in the 22 now and you think you're going to be in the 22 later on anyway, you might want to do them now so that you can, if it's going to be, because, right, if you pay the exact same tax bracket either way, then it doesn't matter. But as we talked about last time, there's more to these tax brackets than just the simple brackets. You've got those brackets, the 10, 12, 22, etc. But then we also have, especially on adjusted gross income up here, you've got taxable income on this side, adjusted gross income on this side. You've got all kinds of different other things inside of here, right? And so one of the big ones for the next 4 years, right, you've got the senior bonus deduction, which phases out between 150 and 200,000. So as your income goes above this, if you're between 65 and if you're 65 and older, then you start losing out on that deduction, right? when you start hitting these numbers here, 218, 274, etc., that's your income-related Medicare adjustment amount. So you're going to pay more on your Medicare if you're over 65 if you go through those thresholds. We also have this number here, 250. That's where if you've got, going back to our different account types here, if you've got a bunch in brokerage over here, and you're earning interest, the dividend, the capital gains, and all these things on those, you will pay. Not only will you go eventually from 0 to 15% on that, but you will also, once you get over that line, pay an extra 3.8% on those taxes as well. And so for some people, they're like, well, hey, I'm in a certain tax bracket now, and so I don't think it makes sense to do Roth conversions. But later on, you're going to, your taxes might push you in, and it's not just about the brackets you're in, it's about all these other ones. So where am I now? Which of these brackets am I going to hit, depending on where my income is, anywhere in here for this year? Where is it going to be anywhere in here in retirement? Where do we think that's going to be, right? So doing some good projections, some solid math, some spreadsheets, some financial planning software, which we'll show you in a second. Some of those things can really help us know, hey, where are we going to end up in all of these thresholds? The other thing that's important that's not on here is the amount, is how much of your Social Security is taxable. And so for some people, right, they're like, well, hey, I'm here and I'm going to be here anyways in retirement, so it doesn't matter. I'm just not going to do it. Okay, yes, but if you're not in Social Security now, and you will be later, then you might still want to do a bunch now to the top of this bracket, because then you can reduce your income later on, and less of your Social Security will be taxable, and you're saving even more taxes, right? So we really want to know all the different brackets, both now and later, and how does Social Security and that taxability factor into all these things when it comes to should we do a Roth. And so, right, it does get kind of complicated. It usually takes spreadsheets, financial planning software, something like that to really figure out where we're going to be. This is not back of the napkin math things, but the difference between paying an extra 10% on 50 grand or not, right? That's $5 grand a year. For 20 years, that's 100 grand in taxes. Do you think it makes sense to spend a couple hours trying to do this yourself to potentially save 100 grand over your lifetime? Does it make sense to pay someone a couple of grand to potentially save you 100 grand over your lifetime? I think it does, right? There's a lot of things that are going on here. And so kind of the way that we think about it with conversions too is kind of like you've got your tax phases of life, right? Let's zoom out a little bit here. And so if we look at a timeline of where you might be in your life, we have a few different phases where it might make sense to do Roth conversions, right? The first one is going to be if you're, pre 59 and a half, you may or may not want to, because you're usually earning money, usually earning pretty good money. Again, all withdrawals or all taxes need to be paid from another source. So maybe it just doesn't even make sense to do them if you're below this amount here. Then you've got another phase between 59 and 62. And that's where, hey, we can withhold if we need to. So that's not an issue as far as paying the taxes go. And we haven't started taking Social Security yet. And so maybe this is a good time to do it or not, right? The next phase would be 62 to 65. This is where Medicare kicks in. And you maybe you retired earlier than that, and you are trying to qualify for premium tax credits before Medicare kicks in for one or both of you, right? And so you may actually need to suppress your income, and maybe it's better to keep it low now so that you can qualify for premium tax credits. And then later on, after 65, that's when you can go to town on Roth conversions. And then the next one that's going to make sense for a lot of people is, well, for some people, 70 and a half is going to make sense, because that's when you can do qualified charitable distributions. You can send money straight to charity. That will impact some things. But for a lot of people, it's going to be either 73 or 75, which is your required minimum distribution age. That's the age where you must take money out of your accounts based on your income. And let me see here. I think I forgot to print this off. But basically, if you're unfamiliar with required minimum distributions, basically the way that they work is they are going to, at 73 or 75, and basically if you are born in 1960 or after, then your age is 75. If you were born before that point, then it's going to be 73 or even 72 if you're already in distributions. But that's basically the ages that you're looking at. And the way that they're going to work is that based on your life expectancy, they're going to make you take a percentage of your account out. So every year, December 31st, the balance of all your traditional IRAs gets reported to the IRS, right? And so if you've got at the end of December 31, 2025, if you had $1 million in that account, that's going to get reported to the IRS. And then they're based on your life expectancy to say, hey, you need to take 3, 4, 4.5, 5, 6% out for that year. And each year the percentage goes up. You have to take more and more out of that account as you age. And so for some people, RMDs are really going to become an issue. And so you may need, right? Maybe we don't want to do Roth conversions here or here or here because of Medicare and other issues. But then between 65 and 75, we really want to do a bunch because we need to do a whole lot before our required minimum distributions kick in and tax the pants off of us. So let me give you an example of what we mean by that, because the danger I think for a lot of people is they underestimate what RMDs are going to do to them and to their retirement over time. So I'm going to, I think I forgot to cue this up, but I should be able to get this going here. Share screen. Let's do this. Perfect. Let's do this. Let's get rid of this guy. Is that going to work? We're trying to do this live here. Oh, not that one. We'll get it figured out. Is that going? Oh, I just hit it again. Okay, perfect. Sweet. Okay, so this is our software. It's called eMoney. We use it. It's like the most expensive planning software I think you can get. I think it's the best. I've used a bunch of them, and we've settled on this one. But Chuck and Diane, they are 61 and 60 years old. They're retiring next year when Chuck hits 62. They've got about almost $4 million, and so they're doing okay. And over the course of retirement, they're not going to spend it down, right? So they're going to end up with more at the end of their life than they started with. Now, this is all in future dollars. So by the time they get out there, it's not going to be worth that much. And so we always like to look at it in present value, where we can say, hey, what is this actually going to be worth by the time we get out there? And with that, we can then see, hey, it looks like Chuck and Diane are mostly living on the gains. They're storing a little bit more than they're spending it down, which is great. But they end up with plenty of money. And if we zoom in here a little bit, just on the next 10 years or so, and we can also look at their cash flow, where they're pulling their money from, right? And so this blue line here, this is their salaries between the two of them. And this red line here, that's their expenses, right? What are they actually trying to spend in a given year, right? And so for the last year of working here, their salary, you can see, is higher than their expenses because they're saving money into their 401ks and whatever, right? So that's very typical. And then they retire, they claim Social Security for one and then Social Security for others. So that makes a base layer of Social Security for them. And then if they want to spend up to the red line, which they plan to spend a little bit more for the first decade or so, go do some fun things, knock off some bucket list travel, etc., they need to withdraw over and above their Social Security to hit that red line, right? So first decade or so, it looks great. If we keep extending this out, though, eventually they hit 75 for one and then 75 for the other. And the orange lines here, that's the required minimum distribution. And so by about a decade or so here, 15 years or so, when they're both 75, their required minimum distribution is $166,000. And they did not need or want that much to do what they want to do, right? They're planning to cut expenses, a little bit, they'll be in their 70s by then. But you can see that the orange blocks go above the red line. It's literally, if we even go back to, I don't know if we're going to be able to share this many things over. If we go back to that chart, right, they are pulling out more than they need, and so they can spend more if they want, or they're going to have to reinvest that, but they're going to have to reinvest it into a brokerage account because you cannot satisfy the required minimum distribution with a Roth conversion, right? And if we keep going, it just gets worse and worse and worse, and their RMDs are more and more above their expense line, right? They're way out there. The other thing we can look at with this is we can look at their tax brackets. And same thing, first decade or so of their retirement is looking pretty good. They're in this tax bracket now. They're planning to stay in that tax bracket. That's why they're capping their spending at that amount. Hey, we want to stay in the 22% tax bracket. We don't want to go up past this blue line, which would be into the 24% tax bracket. So we'll hit that for a while, and then when we ease off, we'll pay even less taxes. This will be great. But again, if we extend this out, once those RMDs kick in, because it's having them pull all this money out at their highest marginal tax rates, pushing them into the 24. And then when Chuck passes away, we see all these lines tank off real fast here. And that's because when you go to one person, right, you go to single tax brackets. And so all the tax brackets get cut in half, but they still have just as much money. So all their RMDs stay the same. And so she's paying now, not just in the 24, but she's paying in the 32 and even the 35% tax bracket later on because they don't spend enough. And so that's where we always want to look out and say, hey, are your RMDs going to be an issue? And we don't want to worry about too much about solving for next year and the following year, like these short-term tax issues, if we have a tax tsunami coming at us down the road, right? And so it's really important. And I think a lot of people underestimate what their accounts are going to grow to. How you invest it really matters, right? But this is going to be a big problem. And so what we could do, right, is we could do a bunch of different tax planning, do a bunch of conversions, etc. And for them, it may be, hey, let's do a bunch of aggressive conversions up front, and then some smaller ones later on. And this got messed up a little bit here. Which one do I need to turn off? One of these. Anyways, we wouldn't do it this hard and then waste this tax bracket here. But either ways, you kind of get the picture here. I got to fine tune this. And so you can do all that, right? And that's going to do a few things. So one, if you're going to go into the 24% tax bracket anyways, manually, or because you're going to be forced to later on, you might as well do it manually up front. Be proactive with that, right? And then instead of, then they're in it for 6 years or 7 years, whatever this is, instead of for 20-something years. And they stay out of the 32 and 35% tax bracket entirely when it's just one of them. And part of that, again, is if you are doing Roth conversions, a couple things that it's doing is one, you're choosing which tax bracket to pay it at, which is great. But then two, because you're moving money from your IRA into Roth, you're lowering your Roth IRA, or you're lowering your traditional IRA balances, and therefore your RMDs, your required distributions off those balances, are much smaller. And so now, yes, they still have RMDs, you always will after that age, but now they are smaller than what they wanted to spend anyway, and so they aren't a problem anymore. Right. And so we see this a lot. And so for a lot of people, it's in tax planning, right? Planning for future taxes. How do we have the most amount of money after paying taxes over our lifetime? Is looking at these different brackets and saying, hey, how much and for how long should we convert to make sure that we solve this issue? And if we look at it from just a total portfolio standpoint, right? If you do a bunch of conversions and you're writing $50,000, $10,000, $20,000 checks to the IRS, you will have less money. Right. And so for a while, they have less money after, like, this gray line is where they used to be without doing the conversions. The blue line is where they are after doing them. So they are, $500,000 short after doing a bunch of conversions. But now when you have all this money growing tax-free, they end up with quite a bit more over their lifetime. And so they pay less in taxes. What was the tune of, let's go back and look at that quick. Taxes, tax brackets. So they pay $640,000 less in taxes over their lifetime. And again, this got messed up. I got to go fix that and end up with about $2 million more after doing all that. So it can really make sense to do conversions, but at the same time, you don't want to do too much. You don't want to pay extra more than you have to. And so really the questions for Roth conversions are how much and for how long would we want to do those? Software like this can really help figure that out. So if we look at the different phases, how much should we do, et cetera, all these things, I think one thing to really pay attention to, right, is we want to begin with the end in mind. And if we look back again at those tax phases of life, like really, where are we going to end up down the road? How much, what are we going to do with our legacy? Where are we leaving this money to? Because if we're leaving it to kids, then it's not just about how much taxes you pay during your lifetime, but also how much they're going to pay, right? Because if we go back to our charts here, right, if you got a big IRA and you're leaving, $3 million in there to your kids, and so you got 3 kids, and you split that out, and they each have $1 million per account, they can put that in an inherited IRA. But then they have 10 years in which they each need to pull $1 million out. It's $100,000 plus per year, which is all going to go into their highest tax bracket and mess up all their other tax brackets as well, right? And so it's not just about how do you minimize your own tax over your lifetime, but how do you minimize those legacy taxes for the next generation as well? You might say, I don't care, I'm going to be dead. That's fine, but I think we could do better. And the other thing to think about is if you are planning to give it not to kids, but you're planning to give it to charities and whatnot, right? A little church here. Charities don't pay taxes. So we don't want to do a bunch of conversions at your high tax brackets, only then to leave it all to churches and charities that don't pay any taxes at all, right? We want to give them pre-tax money. And so it really matters, like, where is this all going? And then are we going to spend more of it? Because another option is to just spend more of it, and then you don't have as big a tax problems as Chuck and Diane had. And so just, hey, what do you actually want to do with your life? Where's it all going in the end? And then you would back into, therefore, how much conversions should you do, right? The way you have it invested really matters, right? Because if you have it very conservatively invested and your account balances are going to go like this, your RMDs are not a problem. But if you follow what we teach here in 3D retirement income, which is a far superior retirement strategy, you're going to have a lot more money. And when you have a lot more money, you pay a lot more taxes, and it's much, much more of a problem. It's a good problem because you, again, still have way more money, but it is something to address and something to think about. Right. Hopefully this is kind of helpful in ways to think about this. You'd want to figure out how much taxes are we paying now, right? Which tax brackets and all these other sub-tax brackets are we in? Where are we going to be later? And therefore, does it make sense to pay the taxes now or delay them and pay them later, hopefully at a lower rate, right? But if you think it's going to be at a higher rate later, or it's going to trip other things that we're not going to trip now, yes, you would want to do conversions now. If you want to shortcut all this, you're like, man, that's a lot. Feels like a lot could go wrong. Yeah, it does. So feel free to shortcut it. Work with a certified financial planner, fee-only certified financial planner. There's a link in the description if you want to schedule something with me. We always meet once or twice for free just to see if we can help you out. We want to make sure we can before we would charge you a dime in fees or have you trust us with $1 of your money. If you are like, I don't want to work with you, you just made this video to make me work with you, that's fine. Find someone else. We always recommend people go to fiduciaryfinancialplanning.net, and you can find someone in the network there who's also fee-only, CFPs, has a tax emphasis, all that stuff. So if you want to shortcut it, they can just do it for you. They can teach you how to do it, right? The way I do it is I would teach you how to do it with your stuff. And so we're going to teach you how to fish. And so then if you want to do it yourself after that, great. You know how to do it better. And if you're like, hey, man, that was so great just having you fish for me, and now I know how, but I don't want to fish, and you want to have us just keep doing it for life, that's awesome too. So if you want to know more of these things, right, you can pre-order my new book, Tax Saving Strategies. That is coming out in March here. And so there's some pre-order bonuses and stuff. You can follow the link in the description and get a bunch of goodies for doing that. Okay, now we're going to come to the part in the show that I call Freeman's Rant. We're workshopping that title. Maybe we can come up with something more fun later on. But I was, I like doing education. And I like talking about these things. And so I signed up with a nonprofit that does financial education for communities. And so they basically say, hey, we want to teach these classes, but we need someone local who's experienced to teach them. Do you want to do that? And so I'm like, yep. And so I taught a couple of workshops on taxes, which were great. And then I signed up for one for Social Security. And I just taught it last night. And so they talk about Social Security, and then they go into, hey, this is just part of the puzzle. Here's a bunch of other parts. And so these are the actual slides from the presentation. And so they go through some of these things. And so here's the first slide, right? And so they're talking about, income from retirement accounts, Roth IRAs, 401ks, etc. So they got 3 pros on here, 3 cons, okay? Missing some obvious pros. Not sure these are even the best cons, but whatever. It's important to do pros and cons. Then they got defined benefit plans, 3 pros, 4 cons. Okay, really leaning into the cons on this one. And then they go to general investments, right? Dividends and interest from stocks, bonds, mutual funds, etc. So this would be like your non-qualified or your brokerage accounts, right? 3 pros again, right? And then 5 cons. And so they're loading up more and more on the con side, right? This is not like a 3 pros, 3 cons for each one. And really, really honing in on the risk here, right? And then they go to annuities, which they first list out a couple of different types, and then 3 pros, just 1 con, which is they often require a long-term commitment. And they do have a bunch of fine print down here, which I'm sure you can't read, and neither could the people sitting in the classroom. But I decided I needed to fix the slide for them, because it makes no sense, right, to say, hey, for these ones over here, we're going to go 3 and 3, 3 and 4, 3 and 5. Really, again, making investments, making Roth IRAs, making all these things seem worse, and then for annuities do one con. So again, I fixed it. The different types of these accounts are bad, terrible, and the worst product ever. The pros, which again, I think they were misleading. You maintain control of the account. Not really. You have way less control over annuities than you do the other types of accounts. And so to say, hey, you get to keep this control and you don't on these other ones is absurd. Here's a huge benefit, right? You get tax deferral on earnings, no mandatory distributions. But all those distributions that you do are now all treated as ordinary income instead of capital gains. And there's no step-up in basis for heirs. So they're going to pay taxes on all of it. There's potential guarantees at a huge cost, right? They often require a long-term commitment. Yeah, because you're going to pay a huge surrender penalty if you don't commit long-term, right? They have high fees, bad performance, hidden company favored loopholes. So if the product's not working the way the company wants it to, they can pull some levers and make it work better for them. They provide, yes, a guaranteed principal and income, usually a flat income amid rising costs, which I, again, channeled a lot and how terrible that is in this book here. There's guarantees, or maybe they would have guarantees, but for rising income, but you could do better if just put it in a bank and pulling money out at that point. So annuities in general are terrible. Most of them are super bad. Some are okay. They're never my first choice. But what just irked me, let me get to the next one first. Life insurance. Again, know the difference. 5 pros, 1 con, which is con. It takes time to get the plan up and running, which is the most absurd combination of pros and cons for a neutral third-party educational content venue. And I ran this past a few of the other planners in our office, and they were all like, what? Are you kidding me? So again, I fixed the slide to present it. They're terrible, great. If you need term life, get it. I've got a bunch. Again, we can tell you whether you need it or not without the commission incentive. But pros, I just had to make sure that you know that there's actually cons to each of these pros. Borrow income funds, loans, and take withdrawals up to cost basis. Tax-free loans is great. Yeah, and you pay interest on your own money to use it. That's not much of a pro. No penalties for early access, but there's not much to access. So again, not really a pro. It takes time to get the plan up and running, aka you are guaranteed to lose money on these plans for 10 to 20 years before you finally break even and then have terrible long-term rates of return on the cash value. And the rates of return on the death benefit are not that great long-term either. And the short term, just use term. So anyways, I've got other videos on whether you should get life insurance, whether you should buy annuities, all those things. We might hit them again. But the thing that really bothered me was, right, in a nonprofit education setting, that they're going to, the way that they did pros and cons, right, making all these other plans seem worse by adding a lot more cons, right, 3 pros, 5 cons, and then 1 con, 1 con for these other ones. That's misleading, right? That's lying. And so I made, actually, I think I forgot to put it up here. Oh, there it is. So I also just made this, and I'm not supposed to mess with the slides, but I did it anyway. Which is just where's your sources of financial information coming from, right? And so you got these nonprofit education, which again, the pro here is that there's no apparent profit motive. It's supposed to be a nonprofit. The con is that their material is coming from somewhere. So someone wrote this presentation for them, and they spun it so that people can teach it and then use it to sell life insurance and annuities as a supplement to Social Security. So it's not this whole non-biased thing that we get, right? Media, YouTube, blogs, right? Pro, free content. This is free to you. You're not paying to watch this. Awesome. But the con, right? Like a lot of media exists to drive ad revenue, right? Trying to get eyeballs, trying to get clicks so that we can sell ads. And that's how they make money, right? No one's doing it truly for free. So either they're doing it to drive ads, or like me and a lot of the people, they're doing it to hopefully that you engage with them. But right, no one's doing this ultimately for free. Commissioned financial advisors, you get one-on-one information specifically to you, right? Versus a whole bunch of general information, and then you have to try to figure out what you're doing. But of course, they get paid more to recommend bad products than good ones. Always. The worse the product, the more they pay. And so you have a big conflict of interest there of, can you really overcome and have an objective view of bad products when you get paid multiples more to sell them? And then you have fee-only financial planners. One-on-one advice in your best interest has to be best for you. Doesn't get paid anymore to do one thing or another, right? That's great. The con is they're more expensive. Although I would say, right, if you paid nothing for commissioned financial professional and you end up with an extra $100,000 and you paid 10 grand for a fee-only planner, but you ended up with an extra $400,000, which one was more expensive? And I would say that the free one was $300,000 more expensive than the $10,000 fee-only planner, right? Now, totally biased. I'm totally biased in that. But I did come from the commissioned world, so at least I know what I'm talking about. So just be careful. This is my main, know what the conflict of interest from the source that you are listening to is, would be my main message, right? You know what my conflict of interest is, right? I am doing this. I've said this in other videos. I'm doing this because I am passionate about educating people. I'd rather educate people than sell them. If people like the way that I talk, the way that I plan things out, the way we think through things, and they don't want to do all the work to figure it all out themselves, then they can know and trust me and pay me to do it for them. That is my motive, right? I just think we do it better than that our form of doing it is better than any other one. But you'd want to know what that motive is and what any conflicts of interest are before you take advice from randos and even nonprofit educational workshops. So there we go. Rant over. Be careful. Okay. Last thing then. Quick Q&A here. Rick had emailed into the show, and I thought this would be a good question to answer with this episode. To say, let me fix this stuff here. When is the best time to do Roth conversions? We just talked about Roth conversions, right? And if you're watching the cut up of this later, we had a whole episode on Roth conversions. So the best time, so we're not talking phases of life, right? We covered that already. The best time to do Roth conversions, if we look at a year here, so January, December, right? When is the best time to do these conversions? Ooh, there we go. The best time to do it, the very best time to do it, is when the stock market is down, right? Stock market's going to do whatever it's going to do over the course of the year. Let's say it did that. So from start to end, you were up for the year. That would be great. We'd all be happy with that, right? The best time to do a Roth conversion would be here or here in this scenario. And here's the reason why, right? Let's say that you owned 100 shares of a company and they were worth $100 each, right? And so then that means you have, what would that be? $10,000 worth of this company on January 1, right? And then let's say, so then it grows and now they're all worth, $120 a piece, and then it tanks way off and now they're worth, let's call it $80 a piece, right? So $80 per share. So at this point here, you still have the 100 shares. So in one way, you haven't lost anything, right? Because you still own 100 shares of this company. And now they're worth $80 a share. And so you have $8,000 total in this company. Well, let's say you wanted to do $5,000 in conversions. So if we did them on day one and you did $5,000 worth, right? That would basically, you would convert 50 shares from an IRA. Or I guess you got your IRA over here. You convert 50 shares at $100 a share into your Roth, and that would be a $5,000 conversion. If in this scenario where they're $80 a share and you've got $8,000 worth, we still want to do the IRA to Roth, but instead of doing 50 shares, we're still trying to do 5,000. So if it's $80 a share, how many times does 80 go into 5,000? I should have done this math ahead of time. So 8,000 divided by 50. I should probably be able to do this in my head. So that's 160 shares. Is that right? Am I doing this right? 50 shares. That can't be right. 80. So 5,000 divided by 8. What did I do the first time? 62. There we go. That's more like it. So now, because it's less money, we can do 62 and a half, but basically 62 shares. 62 times 80 is still the $5,000. So you're still converting the same dollar amount, but you're converting more shares for the same dollar, right? And now we have 62, so we left 38 behind. We now have 62 in the Roth. And when this recovers and hopefully hits like a new all-time high of 120, 130 or whatever, we have more shares that are all recovering tax-free versus if we'd done it earlier and you'd only have 50 shares recovering tax-free. Does that make sense? So the best time to convert is when the market's at its lowest, because you can convert more shares for the same dollar amount and let them recover tax-free. Now, if we are here and we don't know what the rest of the market's going to do, what's the best time to convert? Because this is super obvious in hindsight, and you don't know in advance, right? We don't know if it's going to look like this. And so the way that we would say it is, well, hey, in general, first of all, you would want to know what is the total, dollar amount that we want to convert for a year. And then we would say, okay, we know we want to do that in general. Maybe we want to do $100,000 total for the year. And so you say, hey, in general, the stock market is up, not down at the end of the year, right? It was up 17% last year, S&P 500, almost 18. 4 to 5 years on average, the market's up. So in general, we have a 3 in 4 chance that the market's going to be higher at the end of the year than it was at the beginning of the year, right? And so that means, hey, if it just keeps going up, let's say it just does this, nothing but up for the year, then we're better off doing it here, right? But if we do all of our conversions here, we're going to miss any opportunity to do it when it's low. So the way we would typically do is we'd say, hey, let's divide this up and let's maybe do a third of it. Let's do 30 grand right away at the beginning of the year, just in case the market just keeps going up and we end up higher. That way we at least got some in down here. Then if we get a big downturn, awesome. Like in this case, we might do another 60. And we're not going to do the full 100,000 because you don't know exactly what your taxable income is yet for the year because the year hasn't happened. But maybe we do 60 somewhere in here, right? Awesome. And then at the end of the year, we would do the last 10 just at the end when we know for sure. If it never does this and it just goes up and up and up, we would just do it at the end of the year when we know, right? And that now we would have been better off doing all of it up front, but this at least gives us an opportunity to do some in a downturn if it is. If the market's at all-time highs and has been for a while, and it's been a few good years in a row, like we have now here in 2026, the chances of a downturn get higher and higher as the market gets higher and higher, right? And so there's a better chance that the market's going to go down this year than there was that it was going to go down last year, right? And so will it go down? Who knows? No one knows. But probably would be a good thing to wait and see if something happens throughout the year where we could then get some good conversions in a down market. So kind of 3 times, some at the beginning, some in a downturn if possible, the rest at the end of the year. That's the ultimate best. But you need to know at the beginning of the year how much you want to do, which means you need to do all your tax planning at the beginning of the year and not just wait till November or, God forbid, all the way until next year and try to plan for last year. That doesn't work. So hopefully that answers your question on when the best time to do Roth conversions is. Okay, perfect. So that's today's show. Hopefully that was helpful for you. We'll be back next Wednesday, 4 p.m. Central Time to do it again. And we'll have more topics, more things to discuss. In the meantime, you can catch all these things later on. We also have them on the podcast feeds, etc. Feel free to pre-order the book. We will also send you this one. If you want to become a retired member, you get some more free goodies for that. Again, we're happy to just put out stuff for free, educate people for free. We believe the information should be free, and the work and implementation, that's where you pay us if you want to. And so great. Hopefully that's helpful to you. Be well. Have a great one. Cheers.